Hello, everybody. In Module 6, I discuss information processing costs and rational inattention. Module 6 has 6 lessons. Today, we focus on Lesson 2, limited attention and information disclosure, as discussed in the previous lesson. Relaxing the assumption that investors can process information perfectly and instantaneously has the potential to explain empirical phenomena. One example, among others, is recognition versus disclosure of accounting information that we are going to discuss in the later parts of this lesson. More broadly, in traditional models of analytical accounting research, informationally equivalent signals are treated the same. Despite, in reality, they could be presented in different forms, and they could appear in different parts of financial statements. So they could be perceived differently by a market with finite information processing capacity. Therefore, assuming that investors have limited attention and limited processing capacity may generate novel implications in different disclosure contexts, which is the topic for this lesson. The discussion of this lesson is based on Hirschleifer and Tao 2003 JAE paper. Their paper proposes a standard asset pricing framework and then discuss accounting implications. So the framework has 3 days. At day 0, investors, they're endowed with wealth and they form some prior expectations about certain exogenous states of nature. At day 1, public information arrives and trade occurs. Public information can be interpreted as accounting disclosure. At day 2, all the uncertainties are realized. There are a continuum of investors on 0, 1. 1 minus F, they are attentive to all the available information. F, they're inattentive to certain information. One can think about 1 minus F as sophisticated or institutional investors, and F as unsophisticated or retail investors. So F is an inverse measure of the degree of sophistication of the market. Investors have mean variance preference. And there are different types of expectations representing different types of investors, inattentive or attentive. As is standard in asset pricing models, each investor endowed with some wealth, including shares of a risky stock. And they can trade stock at date 1. The stock pays a liquidation dividend or terminal value at date 2. And each individual chooses their demand to maximize the expected utility function. First order condition results in the standard result. The demand would equal to expectation of the terminal value of stock based on their information minus the stock price at date 1 divided by the risk aversion coefficient times the conditional variance of the terminal dividend. Market clearing condition is going to generate the market price. If we further assume that the initial endowment is 0, then the market price would equal to the weighted average of the 2 groups of investors' expectation of the terminal cash flow. This weight would depend on the proportion of attentive versus inattentive investors, as well as the conditional variance of the terminal cash flow of attentive versus inattentive investors. Public information is represented by Kasai and P. And we assume that the terminal liquidation value is a function of the public information. And so each group of investors, they're going to form the terminal value of the firm based on their understanding of public information. Inattention is modeled as inattentive investors perceiving some or all of public information to be some other incorrect values. Now let's look at applications. The first application, pro forma earnings. Firms, they often disclose good pro forma earnings, followed by recognition of not so good GAAP earnings. In the model, it's assumed that the GAAP earnings will be released at date 1. The manager learns the GAAP earnings at date 0. The relation between GAAP earnings and the terminal cash flow depends on the underlying state. Both the manager and investors know about the state, but inattentive investors choose not to pay any attention. If the state is N, then GAAP earnings is the best predictor of firm's future cash flow. If the state equals E, then GAAP earnings epsilon 1 plus A will be the best predictor. This A is assumed to be exogenous and publicly known. Upon observing the GAAP earnings epsilon 1 at day 0, the manager decides whether to disclose pro forma earnings and whether to disclose that as either epsilon 1 or epsilon 1 plus A at date 1. Attentive investors are assumed to be able to always undo such adjustments. But inattentive investors, they would take whatever manager's disclosure of pro forma earnings at face value. The manager's objective function, while looking complicated, has a quite intuitive explanation. The first term represents the short-term price incentive. The second and third terms represent the manager's reputation gain from making the adjustments at the right states, or the reputation loss from not making the adjustment at the right state. It can be shown that in equilibrium, the manager follows a threshold decision rule, which means that the manager is going to make the adjustment only when A is above some threshold. Intuition is as follows. If the manager only cares about the short-term prices, then the manager is going to adjust whenever A is bigger than 0, regardless of state, because this will boost the short-term price, because there are inattentive investors who just take the performance disclosure at face value. In state N, however, this adjustment is not the right adjustment, so it's going to hurt the manager's payoff by increasing the third term. Therefore, the manager is going to adjust whenever A is sufficiently large such that the price benefits is going to outweigh the reputation cost. The threshold at state N is positive, which means that performer earnings is higher than GAAP earnings. They also have some other empirical implications, which they argue is consistent with the empirical findings. Second application, option compensation. At the time the paper was written, firms do not recognize option compensation expense in their main financial statements, but they disclose the expenses in their footnotes. The markets, however, does not seem to respond to the disclosed expenses in the footnotes. So in the model, the manager is granted some call options at day 0. The call options give the manager the right to exercise a fraction of the firm's shares with some cost. The option can only be exercised at date 1. The manager's payoff, of course, is determined by the maximum of the payoff when the manager does not exercise option, which is normalized to 0, and the payoff when the manager exercises the option. Shareholders' value can be determined correspondingly. The firm's two peers, cash flow F1 and F2, they're correlated. Assume the persistence component, or the persistence parameter, is gamma. If option expenses, they're included in date 1 earnings, then the GAAP earnings is going to be smaller than F1. How much smaller depends on this parameter beta. Beta determines how much proportion of option expenses should be included in date 1 earnings. When beta equals 1, then all of the option expenses are included in date 1 earnings. When beta equals 0, this is the same case as when option expenses are not included. Then the GAAP earnings epsilon 1 equals F1. Rational inattentive investors, they understand the difference between epsilon 1 and F1. But inattentive investors, they don't. Because the manager is expected to exercise the option, we can calculate the option exercise expense. And we can correspondingly calculate the expected value of date 2 cash flow from the attentive investor's perspective and from the inattentive investor's perspective. The firm price is then the weighted average of those two. We can see that full expensing results in undervaluation because full expensing lowers the earnings, and inattentive investors just take earnings at face value. And of course, no expensing would result in overvaluation. So to achieve the right valuation, the optimal beta is 1 over 1 plus gamma. This would result in the same price as the perfectly rational price because undervaluation and overvaluation from the inattentive investors, they're perfectly balanced. The implication is you should recognize less of the option expense if your earnings are more persistent. Now let's look at the third application, segment reporting. A firm with n segments, each segment has different growth rates, and the earnings is shown as follows. Essentially, it's the sum of the earnings of each segment with different growth rates. For fully attentive investors, they understand everything. Inattentive investors, they do not differentiate the different growth rates among segments. They just perceive that the growth rate is the same for every firm. And one can show that the fully rational price is going to be larger than the price with inattentive investors. The reason is, for inattentive investors, they extrapolate the firm's growth rate as the average growth rate. So they ignore that for fast growing segments, they're going to have increasing weights. And so price is going to be inefficient. Secondary reporting is going to help make this attentive, and so increases firm value and move the price to be more efficient, to be closer to firm value. To conclude, Hirschleifer and Tao is a first step toward applying these concepts of being inattentive in accounting and provides an alternative way of thinking about accounting issues. However, in their paper, inattention is assumed rather than modeled explicitly. So they just assume that inattention means that you're inattentive to certain signals. In the next lesson, we're going to explicitly model rationally inattentive. If you want to test your understanding of this lesson, you can take a review quiz at the link provided in the slides. Thank you very much.